All right, stocks up in trade, but what's really soaring is Chola Investment on your screens. We've got Arul Selvan, who is the president and CFO of the company, now joining in to discuss the quarterly numbers. Thank you so much for taking time out. To begin with, you revised your AUM growth guidance to 27 to 30% from 20 to 22% earlier, and you managed to surpass this. So, which are the products, which are the segments that have performed better than what you expected?
So the LAP and HL has performed better, and of course the new businesses have performed better because they had a lower base, and so the growth is seen as a higher from a disbursement perspective, leading to the AUM growth. Vehicle finance have also grown, but because the base is wider or larger, so there has been a it doesn't show up as a larger growth number as a percentage over the previous year. But across all the products we have grown reasonably good. Yes, we always try to take a conservative view of our growth, and we try to promise less and achieve more. That's been our conservative approach. And regarding FY24, while there seems to be a good amount of demand, again you have to factor in the same reverse thing that the base is going to be larger of on FY23 achievements. So from there, the growth numbers I would right now at the beginning of the year put it in the range of around 15 to 20%. I would rather say it would be more linked to the industry growth rather than so we should be growing as fast if not better than the industry. It's better to look at it from that perspective rather than taking a number per se.
Sure. Let's talk about the various segmental performance and would like to get your take on the vehicle finance business. Your disbursements have grown by about 39%. But what about the competitive landscape here, especially when it comes to banks entering into the same space? Are you being able to take incremental disbursements at higher yields?
We have been doing this business for last so many years, and in every time frame there had always been banks competing with us on different sub product profiles like cars, CVs, HCVs, etc. The trick is to carve out a niche for yourselves in which you have barriers of entry from others. And if you look at it, we have created that niche by addressing the small road transport operators. That's one way of looking at it. The second way of looking at it is to look at the application of the product which you are financing. Is it more towards a productive purpose and providing livelihood to the end customer? So that makes it more stickier, and that makes it that the customer ensures that the product is serviced. So these things, as well as a wider diversification, both geographically as well as from a product profile, has made us, competitive with regard to other players in the industry. So every player, like there's a bank or a, NBFC or a, non NBFC like your uh, unorganized segment lenders, etc. Each have got certain profiles which we work on. Generally it's very difficult to breach. For example, we can't get into the salaried segment for cars because the banks yields are so low that we will never be competitive. So each has got a segment to work on, and that's how we you know progress in these segments.
Past, we've observed that generally you take it slow whenever you test waters. But the new businesses have grown multifold in last few quarters. Wanted to get a sense of collections and delinquencies that are shaping, and does this give you comfort to continue the momentum here?
New businesses are doing well. See, you also got to look at it from the perspective that when we enter a business, we need to do certain, you know, percentage of the business. And if you look at the market size of the SME lending book or the CSL lending book, the market size is so huge. Unless you do certain limited numbers, you will never get the experience of handling this portfolio. So you can't compare every, like for example, you can't compare this with the simple two-wheeler market which we entered, where we started with one product and then experienced it over 3 or 4 years before scaling up to other products. The market size is huge, so if you need to have a reasonable sample of the market, you need to work on certain minimum size to ensure that you get the flavor across all customer profiles. And that's the approach we follow. It's not like we have gone aggressive in these segments. We have been very constrained, and we have done this in a very controlled manner.
Now, given that there's a lag between asset and liability repricing, given the nature of your loans, especially on vehicle finance, how has the repricing of loans happened here, and how many more quarters till the overall book reflects the new rates?
The repricing has already started. Last 2 quarters, we have started repricing on the new book. Now, it will take at least 4 to 6 quarters before the size of the repriced books, that the book loans that we are getting into, becomes larger, because on the other side you will have rundowns of the old book. So it generally takes around 5 to 6 quarters before the shift in between the yields levels of the portfolio happens within the vehicle finance book. But the other portfolios where we could reprice, we've already done, and you would have seen that the names are already better than the first few quarters.
Okay.
Right. Furthering that, your vehicle finance NIMs are under pressure given the fixed nature of the loans. But with the floating rate book, LAP, and home loans, and newer businesses contributing meaningfully as well as rising cost of funds, how should we expect your NIMs to move in the full financial year?
NIMs will be, maybe have a slightly further, compression in the first 2 quarters. My guess, we need to see what is the reaction to the Fed increase that happened yesterday night, and whether RBI is going to continue its stance as at a past level, or will it follow suit with a hike in repo rate. These things will make differences with the NIM levels, but we need to understand that that's one element of the profit and loss statement, or the profit that we have to achieve, and we need to manage this by either increasing yield, reducing OPEX, reducing NCL. These will be the way that we need to achieve the committed ROTA, which we always say should be the 3.5% pre-tax levels. We stand by that level of achievement, and we will work towards making sure that that is returned, irrespective of what happens with cost of funds across the board.
Well, asset quality has improved this time around with the collection efficiency of nearly 130% in Q4. Provisionings have also declined sequentially. So, what comfort do you have in terms of asset quality targets in mind?
Again, the COVID too had been the period of aberration with regard to the asset quality across products, and it is the same with regard to many of the other players in the market also. Progressively from the peak of that level, we have been bringing down the NPAs and the delinquencies, both in stage 2 as well as in stage 3, and we have already come to the levels of the pre-COVID NPA numbers. So we will work further to reduce this, but I think we are fairly where we should be, considering the mix of the customer profile that we handle and the portfolio size that we are working with. So we need to make sure that this is controlled, and there will be cyclical moments of this. Like for example, in any Q2, Q1 and Q2 of any year, there will be a slight increase in the NPAs, because both from because there are inauspicious months, and there will be lower economic activities in the first 2 quarters, and once the festival season starts, you will have significant action on the ground, where people earning potential becomes stronger, and so their servicing capability becomes much more better.
Appreciate your time. Thank you so much for joining in and giving us a view on how things are shaping up. Take a look at that stock yet again, revisiting, as it's holding out smartly in the green by about 8%. We'll take a very short break right here on the show.